Just give me a second. Yeah. Right. What's in store for us today? Today's is jobs, tariff, and treasuries, the triple play steering the markets. July's non-farm payrolls disappointed sharply with just 73,000 jobs added versus consensus of roughly 125,000. May's and June's tallies were revised down by a combined 258,000 positions, underscoring a clear deceleration in labor market momentum. Now, the part that I think is also important is the unemployment. And the unemployment rate rose to 4.2% from 4.1% in June, and average hourly earnings growth cooled to 3.9% year-on-year, the slowest pace since early 2021. Now, these data drove a dramatic shift in Fed fund futures with odds of a 25 basis point rate cut in September leaped from about 41% to over 90% after the report. Now, market participants now price in 3 consecutive quarter points cuts starting in September, anticipating that slowing jobs growth and rising unemployment will compel the Fed to ease to fulfill its dual mandate of maximum employment and price stability. Okay, this is definitely a big development. Now, the tariff timeline and the bond market break. Since April 2, 2025, the administration's reciprocal tariff program has been repeatedly delayed from its intended launch to April 9th, then July 9th, and August the 1st, and most recently August the 7th, citing everything from bond market stress to custom system tweaks. Now, the bond market, and in particular the 30-year Treasury yield, has emerged as the ultimate check on these measures. When the 30-year yield spikes above 4.8% in early April, it threatened to push long-term borrowing costs so high that the administration paused its tariff for 90 days. Each prospective tariff date has since been calibrated to avoid renewed bond market routes, illustrating how long-dated yields now dictate trade policy timing. So unlike the Fed, which primarily targets overnight rates, the president's team watches the 30-year yield as the truest barometer of the economy's capacity to absorb higher borrowing costs. A sustained rise above roughly 4.8% has consistently led to tariff policy reversals because it amplifies the drag on housing, infrastructure, finance, and corporate debt services. Now, April's sharp sell-off vividly demonstrates how quickly a bond rout can derail trade policies. Okay, so the weak job reports not only raised odds of Fed easing, but also sent Treasury yields stumbling. A 10-year yield fell from roughly 4.4% to about 4.25% as investors anticipated rate cuts, while the 30-year yield is back below its pain point. So when the long-term yield falls, the rate used to discount future corporate profits also fall, which makes stocks look more vulnerable and helps push share prices up. That's why tech and growth names jump when the weak jobs report drove markets to shift from a roughly even chance to price in a Fed rate cut in September, and long bonds steadied. Okay, long bonds here refer to the longer term bonds. But higher consumer prices from tariffs can lift inflation, which may keep long yields from dropping much further and hold up the extra return investors demand for owning stocks. Okay, so now what's it for the investors? Investors now confront a policy tug of war. Imminent Fed rate cuts promise more liquidity, lower discount rates, and further compression of bond yields, which would support equities and credit. At the same time, tariff remains an inflationary drag that may prevent longer-term yields from falling as far as short rates futures imply, and may keep stock rising premium elevated. Okay, so if yields spike again as tariffs take effect and provoke selling in treasuries. Another policy delay could follow, and markets might quickly rebound, creating a buying opportunity in stock, cryptocurrencies, and precious metals. Alternatively, if tariffs are implemented without triggering stress in the bond market but still unsettle equity investors, a disciplined dollar cost averaging strategy can help smooth volatility and capture gains during a recovery. Okay? Investors should monitor labor market releases, Fed communications, right? These are important, and most important, the 30-year Treasury yield and tariff implementation dates to time potential entry points and guard against renewed import cost pressures that could pin yields and valuations higher, right? Okay, so where are we now? Actually, I've looked at the 30-year yield, right? And there is this possibility that the tariffs are implemented and it's not triggering stress in the bond. Okay, so far. Okay, but whether it will unsettle equity investors, that is, we still need some time because prices is right in the middle. Okay, of a very important, it's on a fence. It can move either side. Okay, so anyway, if that's a correction due to this, then like I said, a disciplined dollar cost averaging strategy can help smooth volatility. Okay, this is one strategy that you can look at. But we'll see for the next 6 weeks. Things will be much clearer. We will see those movements, and it will be clearer how to deal with it as time goes on. Okay, with that, that's the report for today.